Hi everyone. Okay, now we're going to take a look at problem P6-38 that starts on page 368 of the text. Um, in this particular problem, we are basically doing the same thing that we did in the previous problem, except for it looks a bit different. So you're going to see in the text question, you're going to see a bunch of different dates with different transactions that have occurred. Most of this you can ignore. What we're going to be looking at are what has happened on January 7th, on January 18th, on the 22nd, and on the 31st. So on January 7th, January 18th, January 22nd, and January 31st. And in regards to January 31st, we're only really looking at 31D. Okay, so everything else can pretty much be ignored in here. So what we're going to be doing is we're going to be taking a look at some transactions that have occurred in terms of purchasing inventory and selling inventory. And what we're using in this particular problem is the FIFO method, just like we used in the previous problem where we had FIFO, LIFO, and weighted average. This problem, P6-38, is only going to look at FIFO. So we want to take a look, and another thing I want to mention is that we don't have any beginning inventory that we're starting with like we did in the previous problem in P6-34. There was a beginning inventory. In this particular case, there's no beginning inventory. So it says on January 7th that they purchased 50 units of software on account for 1,050 plus freight in. Now, if you'll notice, so we have the quantity, it says 50. However, you'll notice that we do not have a unit cost. It doesn't tell us how much each unit is. So we have to work backwards, so to speak. So that's what this down here is for, is where you're going to calculate the unit cost. And all you do, according to this definition here, this calculation, in order to determine the unit cost, you take the total cost divided by the total number of units. So it says that they purchased 50 units on account for 1,050 plus freight in. So it's important, it's total cost. So you want to include that freight in. So you're going to be taking the 1,050 plus the 50. You come up with 1,100 and divide by 50, and that's your unit cost that you're going to plug in here. Then you take your quantity times your unit cost and you come up with your total costs. And that's going to be carried over to your inventory here. That's what you now have on hand. Because remember, we have the purchases in this column. We have those that the cost of goods sold, so anything that we sold in this column. And then this is the inventory on hand. So after every transaction, whether we have a purchase or whether we have a sale, we have to record what is left in the inventory. Okay? So in this particular case, again, you have to back into the unit cost. Another thing that I wanted to point out is that on January 31st, we only have to do Part D. And it's a little confusing because in Part D it says physical count of software inventory is 50 units. What is that telling you? Well, if we've kept our inventory on hand here, we've kept a record, we're going to have a certain inventory on this date, on the 28th. We'll have what's inventory on hand. What they're telling you here is that when they do a physical count of inventory, there's 50 units. Well, you want to take the difference between what the physical inventory says to the 50 units and what you have as a quantity inventory on hand as of the 28th. And it's here that you're going to have to make an adjustment, because if it's off, which it will be, we have to make an adjustment. We have to assume that the difference in the inventory count was sold and that we just didn't record it accurately. So whatever that difference is, you're going to be putting in here as the cost of goods sold. Now remember, you always want to use for the unit cost what it actually cost the company to purchase that. We don't care what they sold it at this point, okay? So you want to use that unit cost that you calculated earlier for the 7th and the 26th. Okay, I think that's all I want to say about this first requirement. Let's go on to the next one. So requirement 2 says journalize the transactions for January 18th, for January 28th, and for the 31st. So these are just regular journal transactions that you're going to be recording here. Now, there's January 18th, 28th, and the 31st. But if you've read the textbook, you'll know that every time that you sell inventory, every time that you sell a product, you have to make 2 journal entries. You have to record the actual sale, and then you have to record the effect on inventory. So on the 18th and on the 28th, you'll notice that I have a lot of spaces there. That's because you're going to be putting in 2 transactions for each of those days. One for the sale, whether they sold it and they received cash for it, or whether they sold it on account. Okay? Now, you're going to just use these available accounts over here, and they pretty much go in order, so you should be able to figure it out. Okay, so on the January 18th and the 28th, you're going to record the sale that occurred first, and then you're going to record the effect on the inventory, what happened to the inventory, and therefore the cost of goods sold. You're going to be recording that cost of goods sold expense along with the effect on the software inventory. And then on the 31st, you're just going to be doing a recording the journal entry for that what happened on the 31st in Part D, the physical count, adjusting the software inventory for the inventory shrinkage. So that is what is required for requirement 2 of this problem. Okay, I think that pretty much covers it. I hope this helped. If you have any questions, always feel free to call me at 602-639-7378. Thanks so much.